So hopefully everybody here has had a nice day today and has learned at least a couple of things. Maybe has now had a few snacks. So come on in, and we'd love to talk to you a little bit about some institutional investors and also family offices that are all very sophisticated investors and doing different sorts of things around the world, but all of which are quite interesting. And we're going to hear a little bit more about exactly what that is. So let me do a quick introduction, and then we're going to ask everybody to describe themselves a little bit more as well. So first, Mark Burgess, who is the chairman of the investment committee for HESTA, which is an Australian super fund focusing on healthcare workers. We have Ollie Weisberg, who's the CEO of Blue Pool Capital. Ollie, nice to have you here. And then Matthew Hoffer, he's the CEO and co-founder of a family office in Zurich called Spire. So Matthew, great to have you here. So, right now we're in a fascinating time of the markets. There's been a very resilient U.S. market. There's been a lot of softness in Asia, particularly in emerging markets. Central banks around the world are doing different things. Central banks in the United States and in most of the Western countries are raising rates. The central bank in China is lowering rates. We have a overstretched consumer for the most part around the world. We have recession looming in many parts as well, and we have some disconnects, particularly in real estate, that are going to present some opportunities for people, among other things. So it's a fascinating time to be an investor. We want to sort of get these different points of views across. But why don't we first start off with, Mark, why don't you give a quick overview of HESTA and what you guys do?
So HESTA is a large pension plan. The way Australia works is about $3.5 trillion in pensions, and the largest funds they come from a history of being industry-based. HESTA happens to be nurses and healthcare workers and all the guys that did the great work in the last 2 or 3 years. It's a top 5 or 6 size fund. We run about $60 billion US dollars, and it's a very diversified fund. Yeah.
Ollie?
Yeah, hi. Thanks for having me here today. Super excited to be here and looking forward to a good dialogue. I'm Oliver Weisberg. I go by Ollie Weisberg. I am the CEO of Blue Pool Capital. We're a multi-strategy investment firm based in Hong Kong. We invest in all the major asset classes, public and private, with a tilt, focused on the U.S. and Asia and some in Europe. We also are active in the sports business. So I think we'll talk about that a little bit later. And I'm originally from the States. I've been living and working in Greater China since the mid-90s. So,
Matthew?
Hi, everyone. So Matthew Hoffer. I'm half British, half Swiss. I run Spire Capital. We're based in Zurich in Switzerland. We're a family-backed investment firm, so backed by 2 families, set up, so the focus is private markets, set up to go direct, and now looking at some fund allocations to take advantage of the dislocations that we've seen in the markets the past 12 months.
That's super. All right, so let's kind of go down the row here and talk big picture in terms of where your portfolio is today. And let's think of the classic thematic things: public, private, geographically, value growth. Maybe also talk a little bit about, if it's private, is it private equity? Is it private credit? Is it venture capital? So just a kind of macro perspective would be great. So Mark, do you want to start with that?
Yeah, so the Australian funds are all very similar, and HESTA's somewhat like this. But HESTA has about 60% listed equities, about a third in Australia, 2/3 offshore now around the world. It's a little more biased to emerging markets within that. Has 11% in infrastructure, a big asset class for Australian pension plans, 6% in private equity, 8% or 7% in real estate. Has a grouping of alternative assets, and then the balance is in fixed income, of which private credit has been an increasing part. So it's a typically well-balanced portfolio with a bias towards listed equities, very common in Australia. Yep.
Thank you.
So as I mentioned, we're extremely diversified across all the asset classes that Mark just mentioned, from public equity to private credit to real estate to private equity and venture. We took the view 18, 24 months ago that we were sort of uncomfortable with where the markets were. So we've been very much in a risk-off mode for the last 18 to 24 months. We just felt kind of uncomfortable with we just didn't understand where the markets were going and couldn't take a strong fundamental view. And so we've been extremely cautious. We're now finally starting to dip our toe in the water. We've been quite active throughout in the sports media space, but in the other asset classes, we've been much more cautious. But now, with seeing a little more glimmer of light, we've been finally starting to invest more capital, both here and in the U.S.
Yeah, so we think now is a really good time to be in the market. We have been in the market, been very, very active this year. So our strategy, we have a thematic strategy, which is digital transformation. So we're targeting companies that are accelerating a digital transformation in their industry. It's something we're really bullish about because we think come recession, come growth, whatever happens in the next 10 to 15 years, every industry is going to digitally transform, and most industries are lagging behind. So we're confident behind the strategy for us, and it's about the stock selection, so to speak, finding the right companies that can accelerate in that. And so because we have the thematic strategy, we are agnostic on the geography. So for example, last year we did 3 investments in Asia, 1 in Singapore, 1 in Hong Kong, 1 in the mainland. So we're agnostic on the geography, and we're also agnostic on stage, the stage of the company. So we do seed to pre-IPO.
So I'm sensing a theme. Ollie, you were talking about kind of being risk off, but you're dipping your toe in. You're talking. I know you're Matthew. You're talking also about being a little bit more opportunistic. And what are the drivers of those changes? What's making you more optimistic?
Yeah, I should have mentioned, because similar to my colleague here, for our private equity business, it is primarily digital TMT related. It's very, very similar. I think there was a disconnect just in valuations, and I think it's taken a while for the private companies to sort of recognize where the right strike price should be, if you will, for assets. It just takes time, and often there's a disconnect between that and the public markets. The private market takes more time, if you will. And so I think we're finally seeing, we just led an investment in a tech company in Germany last week. Most of the investors that came in were ones that had been in the cap stack before, but the company had done well, survived through COVID, made the right cost cuttings and so forth. And so valuations are just more attractive now, and I think it just takes a lot of discipline and patience to wait.
But are you waiting for others to see the mark to market? So you're seeing other transactions that are going in, or are you just going in without having to see them?
I'd probably say it's both. Some of them were saying, hey, this is where we think it's worth,
Right.
if you will, and others saying, okay, look, we know where
Right.
we know where we should be. Sort of a self-awareness.
Yeah.
That's probably
Good
how
for
I'd
you.
describe.
Okay, Matthew, on that one.
Yeah, I mean, for us, so we've been very active this year. We were a bit less active last year, and so around kind of this time last year, we paused, and that was due to the market corrections. And it started, of course, with the public markets, and you just could have a sense that was coming in. There was a tidal wave coming in the private markets. And for example, there's one company we ended up investing in. But we were looking at it last year. We had the opportunity to invest in it. We paused because we thought, if you look at the multiple on the revenue that they're raising at, it's we also took advice and we thought, okay, that is really quite we're at the end of the days of those markets, and that's been proven right, because if you look at private market valuations, they have come crashing down in a big way, right? And the days when a company could raise, with a minimal revenue, EBITDA negative, the days that they could raise at 15 to 20x on revenues, those days are gone. And so we've seen that, a huge repricing in the market, and that's why we feel, us and obviously funds that are in the market, it's a very good time to be there, because the good companies are the ones that have survived, and the valuations are really attractive.
So, go ahead.
I was going to just add one more thing. Like self-awareness, I think, is always important in investing, but I think what I was going to say is, for those of us that have been in the business for a long time, yes, we're here talking about where you can invest, but also we're spending time with our own portfolio companies, making sure if they're having challenges, they're being funded correctly, and so that's something that we spend a lot of time on.
So, Mark, your ship is a much bigger one to navigate, right? To turn. Are you seeing in your portfolio similar opportunities, and how are you acting on that if that's the case?
Yeah, it's a great question. I was at the Greenwich Economic Forum in October last year, and I'll give you a plug, since you can't do this yourself, Jim. But it's a great forum because you get to see global issues, but from a US perspective.
Right.
I don't always agree with the US perspective, by the way, but it's very interesting for us to see this being based in Australia or from an Asian point of view in the US. But it is a fantastic conference. But I did get asked from the audience this question, which is, this was in October last year, are you worried about the risks? And the answer was, which is what all investors would say, is that the risk wasn't last year in October, the risk was 18 months before. We'd just come off a period of about 12 or 18 months where we were getting cash flow and we were unable to find places to put it. That's really risky. That's the stuff that makes you sweat. And by October last year, a lot of stuff had shaken out. In fact, we've been monitoring, if you look at the V shape of the 10-year bond all around the world, but in places like the US or Europe or wherever, there was this dramatic V shape where 10-year yields went down to 50 basis points. Have a look inside the V shape, that time period, that 18 months, and just write down all the excesses that occurred, of which there were many, and then how many of them had already shaken themselves out. And by October last year, quite a lot had actually shaken themselves out. And the only debate left was, could this create a structural flaw in the system, something that creates not just a cyclical bear market, but a structural bear market, which is something of the 72 or 82 or 08 period. And our bet was that it wasn't going to be structural. So we've had problems with the banking system in the US, we've had UK pensions, we heard today about Korean, but we think that the market, one of the great benefits of the 08 correction is that we actually fixed the financial system. It's a bit similar to the correction we saw in Asia in 98. Asia in 98 was so severe that it created behaviours for the next 30 years which actually created stability. And so the benefit of a previous crisis is you often get some better outcomes. And so we made the bet around October that we were roughly at the bottom of a normal cyclical correction of 25%, and so we upped the weightings a bit. Where we're having trouble, and this is raised in the last panel, which I thought was excellent, is that the mark-to-markets in some of the book is just not quite connecting. And what that does is two things. One is you can't find great assets sometimes, which you want to buy in distress. But secondly, it affects your asset allocation. You go overweight unlisteds for a period, and for institutions, it's quite hard to up that even further when you see opportunities simply because the valuations haven't flowed through. Good news, the valuations are now coming through, and it resets the asset allocation. Listed markets are moving higher. The last thing I'd say is just on the consensus. I've just done a tour around Australia meeting all institutions. The average institution in Australia has been underweight risk here, and I think they're being squeezed. They're not aggressively underweight, but they're being squeezed back into the markets because they were just marginally. There's a real consensus to be underweight, and as the markets move higher, it's starting to affect them. So we upped our weightings basically towards risk at the back end of last year.
Okay, yeah, that's great. So you're all consistent in the more risk-on approach. It sounds like most broadly. Let's talk a little bit about China. I think my sense is that the largest institutions in general feel that they need to have some exposure to the largest market in the world here, China. But there's also this sense that, in many ways, for many people, it's uninvestable or uninvestable in certain categories. So the question I'd like to pose is, to what extent is China uninvestable? How do you navigate around that? And can you give any examples of the sort of things you're looking at that would be places you feel are safe and where you think the valuations make sense? So I'll let anybody start with that one. Oh, you grabbed first, right, Matt?
So we did one in the mainland last year. So China's definitely not uninvestable. It just the question I think maybe where you're going is sort of in the political risk direction. And so I think if you look at political risk, and that's true with any market, right? China is one, but any market globally, you have to take the micro view, the bottom up. And combine that with the macro. So yes, if you look at the macro, it's very easy to say, well, country A lot of political risk, we need to avoid that. But in our opinion, the key is to find, well, if there is a certain level of political risk that you're concerned about, then what is driving that, right? So in China, if you look at China, the key is to then say, well, what are the sectors of which the government has zero interest, right? And that's the one that we then focus on. So if you look, for example, let's say we're going to invest in chips or in military, or then you could say, well, the government might have an interest in that. But there are many, many industries in which the government has no interest beyond, well, they want to see economic growth. And those are the industries that then, perfectly fine, perfectly safe, perfectly good to invest in.
What category was your investment in? Like, what can you describe it generally?
Yeah, I mean, so we invested in a wood technology business. Factories in Nantong, it's turning softwood to hardwood. So it's quite a unique technology because there's plenty of softwood around. But hardwood, to chop it down organically, you've got to go to the rainforests. So it's a big impact play. A lot of good, if you look at construction in China, the uptick in demand over the next decade is going to be there. So it felt, there's no interest there from the government. So it just made a lot of sense. We see the demand, and then it's just our due diligence model then can apply itself, meaning, well, we would look at the strategy, look at the people, and we look at the market. And from all that, just made sense. So, it was a go. So that's an example.
So you're chopping wood in China, it sounds like that's right.
Not chopping wood there, but collecting the wood and then turning it into hardwood and then shipping it out to manufacturers.
I think very well said. Let's maybe ignore the politics of what's happening in the world now, but the strength of the Chinese consumer is extremely robust. Pick your number in terms of the middle class in China, the economy is strong. And so we feel like there's power in the consumer. And so consumer technology-related businesses, both public and private, are areas that we're extremely focused on. So despite the cacophony, if you will, in the world.
Can you give some general sectors or industries that you like in particular that you're or at least exploring?
Look, it's ones that are just part of daily life: food, beverage. China, as for people that are in this world, enter in this room who spend time in the U.S. I mean, China has taken leaps and bounds as it relates to technology, and so just the use cases in China. When I'm in China, I don't carry any money. Right. Whereas I'm in the U.S., I'm like rifling for my change and stuff like that. So the consumer daily life is an area that is extremely robust.
Great. Mark, how about yourself?
Yeah, so Australian institutions more broadly, we've seen pockets of people pulling out of China. There's no question about that, or talking about it. But at its absolute core, I think Australians recognise that China is a vital partner for Australia and a long-term grower. I'd also argue that China is going through what I'd call positive structural change. I think it's understated, the focus on fixing the real estate imbalances. I was at a conference in 2011 where people, even before it took off, but the shadow banking issue was being raised with other CEOs. We were talking about it. I was the head of the sovereign fund at the time. And so some of those imbalances are now being dealt with. This is inherently bullish for China. It's got long-term growth characteristics. And so the way most investors get access to it from Australia are through their emerging markets weightings and then also through their indirect holdings through PE firms. So firms like ours have a long-term strategy towards it, and that's generally the case across the Australian marketplace. But I think actually the structural changes that are occurring there are inherently bullish. The downside is the growth rate has to come down. I asked the question yesterday about what the medium-term growth rate is. But that's not to be bearish, that's simply because you should factor it into your numbers. And at these valuations, you get the diversification benefits of it. There are many structural reasons why you've got to be exposed there, and certainly that's been our approach.
So are valuations better? I mean, if you're looking at especially like a basket of EM, I mean, EM in general is more value-oriented than other areas, right, other countries. But are you feeling the valuations are good in China right now in certain sectors?
They're improving all the time, right?
Right.
And yeah, they're not excessive, right, obviously, and emerging has had this terrible decade. Now, we've got that wrong to some extent. We've been overweight earlier than expected. But as they get cheaper, you shouldn't necessarily be backing away. And as we saw in some discussion yesterday, they've begun to re-emerge and starting to perform better. China itself, I'm sure, will get into that state reasonably soon.
Okay.
Jim, I was going to add one more point, and I think this is a mixed crowd of people that are from overseas and local and so forth. We believe in this generation of young Chinese entrepreneurs. It's folks that have built their second or third business. Some of them were at the big tech companies, some of them were at smaller companies, but the strength of the Chinese entrepreneur and the strong work ethic, I think it's incredible. So I don't underestimate the Chinese entrepreneur.
That's a great point. Let's shift gears and talk about, I guess, probably the hottest sector right now in investing, which is generative AI. We talked a little bit about AI here. Obviously, you've got the big elephant in NVIDIA that I think has just recently hit $1 trillion valuation. There's not a lot of other obvious ones that are out there. It seems like it's sort of go broke or go home sort of thing. But if you're looking to get involved in generative AI and you have a longer term approach, what are some good ways to do that? Yeah, Ollie, do it. You go.
Okay. Yeah, no, we'll go. You want to go? Yeah. Look, I think we have a small firm. We have a small team. I've dedicated a portion of one of my staff to just understand what we're all talking about as it relates to AI. So it's been a small focus, but something that I think long-term will play a role in all of our lives. We've been trying to understand how much will AI help the large platforms themselves and just being better, whether that's Google, ByteDance, Facebook, Alibaba, what have you, or whether there'll be a lot of investable AI companies. We just don't know that. So we have a team researching that, seeing how AI is affecting and adding return on investment to the large tech companies. We're looking at a couple of fund investments that are dedicated to AI that have teams that are 6, 12, 18 months ahead of us, if you will, if not farther. And so we're trying to get smart right now. That's kind of our view long term. Just because we're just trying to figure out ultimately what it's going to
Right,
look
so
like.
you don't have the answer, but you're doing the research to be able to get the answer.
Right.
Smart. Okay.
Yeah, I mean, I'd agree with that. I think the key thing in our view on, I mean, if we were to go, let's say AI as a vertical, we would dip our toes out with a fund, and with the experts who know about AI. So we're digital transformation investors, so we would look, is company X accelerating a digital transformation in their industry? If they could be using AI, or for us it's less important what they're using. So with respect, your question was about AI itself. The reason I agree, and the reason I think it's a bit too early to tell, is because it's unclear sort of what direction AI is going to go in. Because at the moment, AI, it's called AI, but it's really pattern recognition, right? It just uses, it's what they call narrow AI. That's the AI that's out there, and it just takes a lot of data, and it does pattern recognition, and that's what the infamous argument or row between Mark Zuckerberg and Elon Musk. When Mark Zuckerberg says AI is amazing, and Musk responds, yeah, your understanding is a bit limited. So Elon Musk looks at AI more in the general sense. And so he's, for him, it's endless, because we already have all the technology today to produce a general AI. Why don't we? It's because we don't understand enough about the human brain. So it's a neurology problem, a neuroscience problem, and that's where the research is. And so, can we, over the next 20, 30, 40 years, develop a general AI? That, I think, is what's interesting, or where the future of AI lies. And the other reason is why I believe that is because on the narrow side, we're going to go slowly into Web3. And Web3, I mean, I would define that in two ways. Number one, it's about how you immerse yourself in the technology versus looking at it. And the second play on Web3 is, of course, the data. Because the technologies upon which Web3 will be built on will be technologies like blockchain, and the data will be, there'll be much sort of greater, data ownership angle. And so if you're owning the data, then it's not the centralized platforms who own the data. And of course, again, narrow AI, it's predictive analytics on data. So that's where I think it's a bit unclear sort of where we're going with it.
Yeah, and I just add, it's clear AI is in our lives today, right now. It's everywhere. And there will be an acceleration of that for all the reasons we've talked about. My point was simply to express a view in investing in AI. That's kind of how we're thinking about it.
Smart. So how does a big, it's basically a sovereign wealth fund, even think about getting alpha from AI?
It's a really good question. We see AI actually because we have 1 million members, and if you go online and talk to us, you're talking to AI, right? I mean, that's the simple, honest truth, and they seem very happy with it. So people are getting the answers they want and the solutions they want in that very simple way. The other thing that we look at AI is we are looking at it with the systems, investment systems. We're experimenting with it, trying it out, using it for quantitative analysis as well. I think the other feature is also just watching the way the market's reacting. It's very interesting that there's a lot of capital chasing these themes very simply. What it shows to you about the investment markets is there's still a lagged effect of excess capital from the previous cycle, I think, which is encouraging these speculative kind of moments. But it's nothing to be too concerned about because it's not that deep. But we don't have a strategy. Instead, it's a bit like you're saying about China. Back those countries, back those cultures that are able to engage and deliver. My wife is scared stiff of AI and has told my 4 kids who are in their 20s not to engage it. I take the opposite view, engage it as fast as you can.
Right.
My son's just become a doctor. He's worried about AI now. But the young guys should engage it because it's going to do incredible things. But unless you're going to engage it, you're going to miss it. And so that's where we're at as an institution. But that's where everyone's got to be at, I think. Yeah.
Okay, now let's go to the other end of the spectrum. So AI growth, opportunities, amazing valuations. Let's look at distressed.
Yeah.
And my favorite topic with distressed is, Greenwich, Connecticut is right outside of New York City. Greenwich used to be a major hub, a Metro North hub into New York. Now you go to the Metro North station and it's almost empty. And it's because the work from home has really impacted certain markets like New York in a very significant way. And in New York City, there's the Class A buildings are doing great, One Vanderbilt, this sort of stuff. But the Bs and Cs, as we heard on the last panel, are struggling. And you can't convert a 60s office building, glass office building into homes. It just, the economics don't work and that kind of stuff. So my thesis is that there's going to be plenty of opportunity, especially in New York, for, if you time it right, to take advantage of some dislocations for, lots of reasons. But not just real estate, but sort of more broadly with distress, with interest rates going up, and all the forces that are making owners nervous that might result in a forced sale of some sort. Or are you guys seeing any opportunities in distressed? And if you are, where might those be? And what's your general approach to taking advantage of distressed opportunities?
So I'll answer the question more generally because, for example, as a vertical, we're not in areas like real estate directly, but where one of the reasons, or the reason why we're now looking at some funds, and we've gone into 2 already this year, and we're looking maybe to allocate to a few more, not more than 10, 12. But the reason is precisely because of the dislocations we've seen over the past 12 months. So we've said, okay, if we can find a good manager in a certain vertical where there's been dislocations, that good manager will be able to make profits, right? That's what good managers do. So our strategy is then, we have our digital transformation strategy on the directs. So then on the fund allocation, let's find interesting verticals, interesting sectors where you are seeing those dislocations, and then it's a case of we'll find the good managers. So for example, things that we're looking at, which I think you were alluding to, Jim. So credit is definitely one we're looking at, and there's a few credit funds, credit managers we're examining. I think the credit distressed space is really interesting. Particularly because, especially on the corporate side, there's a lot of really good companies still out there with good cash flows. So if there's whatever reason they're distressed, they're clearly going to remain. So I think their yields on the distress side can be very attractive. So that's one area we're quite interesting, and we're looking maybe two or three funds in that space. And then other space, digital assets is one where we're quite keen on as well, and then certainly some geographies. And then other kind of verticals we just talked about, like AI and things like that, can be quite interesting.
And you're seeing some distressed in digital assets. You're seeing distressed opportunities as well.
In the funds itself, in terms of what they're allocating, I mean, it's a bit of a, they call it kind of a, whatever, an AI or a Web3 sort of a winter. So I think now is a good time, in our view, to get into digital assets, again, because we'll be a really long-term investor into that. And even if there's a further, let's say, recession or further kind of extension of the current conditions over the next 6 to 12 months, our view as well, if we take, next 10 to 15 years, the digial assets economy is really going to grow. And just be clear, we put crypto in the currencies bucket. So currencies are, fiat currencies and cryptocurrencies. That's currencies. And then separately you have digital assets. And so, like in an economy, right, you've got US dollar, you've got pound sterling, and then you've got your kind of real economy, automotive and so on, right? So if you look at the digital assets economy, I mean, a huge, part of the economy is going to be built digitally, and so there's a huge infrastructure gap there. So that's really interesting. So we're looking at the infrastructure play to go Web 2 to Web 3, and then ditto on the digital asset side, huge parts of the economy built on there. Very bullish about that.
That's a great point. We haven't talked much about that. That's a great point. Ollie, anything distressed?
Yes, I actually used to trade distress a long time ago, and I think older than many of you guys in the room. So went through the Asian financial crisis here, and then obviously the GFC in 2008. We're in the middle of a difficult cycle now. So I'd say in the digital stuff that my colleague was talking about, it's less about credit, it's just lower equity prices. Most of these companies don't have the ability to borrow anyway. So it's typically just better valuations, as we've been talking about. I think for the New York real estate market, we're not seeing that much yet. I think we will. A lot of that has to do with, businesses or real estate assets, underlying costs, where they are and so forth, and how much debt. But I think the commercial real estate market will have a lot of ripe opportunities. We're seeing some so far, but I think not a lot of trading activity. Right. I think people are waiting. I think private lending is a business that we've been involved in for a long time. And I think as a lot of the traditional bank functions that were at banks have moved to this alternative product for private lending, we've been quite active in that for a long time. So we're seeing a lot more of that right now. You're getting better pricing, self-awareness among borrowers is the term I'd use. And so I think right now you can currently achieve really nice double-digit returns with credit-type instruments. And so that's if I was thinking about where we're putting capital out right now, that's very straightforward when we go to investment committee. And I think that's something that we're seeing. I mean, it's relatively straightforward across all sectors. And so I think when you do that business, yes, I agree, in funds is the way to go. But it's really about having the right portfolio construction, because now you can lend to really the best companies that will survive at really nice, attractive rate. Maybe some of them loan plus warrant, you get some coupon and some upside.
Mark, are you doing more in private credit as well? Is that a theme for you guys?
Yeah, and the trend generally is towards more private credit. There's no question about that. But you need to pick and choose carefully. And a well-structured portfolio today has distressed in it, ready to go. Because we learned from '08, others have learned from longer periods. And so we've got allocations to distressed managers as part of a good mix. We've got allocation to real estate investors who act in a distressed way, value guys looking for those kind of transactions. Where distress might be more interesting or might require judgment is in, say, PE, where we're going to soon be approached, I'm sure, to extend funds, to move assets around between funds because they're not yet delivering. And that's a version of distressed, given the capital dry-up that's occurred or the changing conditions. And that's a really interesting test. It's like you were saying, one of the features of the last 3 to 5 years is that there was so much excess capital that many players survived longer than they should. And the example I give to show my age is the old days of video recorders. Beta and VHS was debated. It took 7 years for someone to win. This cycle has been 15 years where stuff has continued. And if you continue to back something that should really be closed down, then you're going to back it and then lose even more money. And so we're making sure that our investors are thinking that through, and there is nothing wrong with cutting a loss if it's just not going to go on. And so we're looking at distress a bunch of ways to add to distress, but also make sure we don't suffer distress in 3 to 5 years because we made bad decisions now because the environment's changed. Yeah.
Okay, great. I want to save a few minutes for questions. We're at a 7-minute mark, so maybe we'll do one more question, then we'll turn it over to the audience if anyone has any questions for our esteemed group of investors here. Opportunities. So each of you sort of has different mandate for sure, and different areas of focus to varying degrees. And I think, Ollie, we were talking a little bit about your firm owns some of the prominent New York City area sports teams. Are there any themes that, in terms of opportunities, that you think are exciting that you might be pursuing or just you're considering? Do you want to start?
Sure. We were chatting about that before too, so I think we have a compatriot, a similar view. So we believe in owning intellectual property. So when we purchased the Brooklyn Nets and the Barclays Center, that was really our investment thesis. As you think of, kind of think like the Grand Canyon, you've got cable and linear and digital and OTT on the other side. So obviously we're going through that transformation right now. So when we looked at buying a sports team, and I think this cuts across all the major sports leagues, is really a view on media rights. It's a way to kind of ride the economic. All of these, it's a much longer conversation. All of these leagues are structured very differently, if you will, in terms of revenue sharing. So I won't go through that. But we really believe that the NBA itself is an incredible, massive media business. And there's a lot of features in the NBA that have the owners and the teams work together collectively. And so I think that was our original investment thesis. People really want to watch live sports. And I think that's something that sounds like a really simple statement. But even during the depths of COVID, people were watching sports, both on their phones, at home, and live. So I think it's something, now, as per the earlier question where we're talking about how do you express a view, right? So you can buy sports teams, there's some public stocks. We're very bullish, short, long, and medium term on sports, media, betting.
All right, great.
So
That's great, cool. Matthew, any tips?
Well, I don't know if it's a tip, so I'm can't be responsible for it. But I mean, I'll say there are three areas that we're really excited about. So one is sports as well, because we're just getting we spoke about it before, just getting dipping our toes as well. But if you look at sports clubs, they used to get their revenues from merchandising and ticketing. Ticket sales, and so the key shift there has been media entertainment. And I was in the US at tail end of last year and speaking to a very prominent sports investor and really kind of started to understand that. And I think that shift, given the appetite individually across everyone globally for sports, to watch sports, it's kind of been insatiable at different sports. And so as long as you got kind of 101 right, you have a demand. Well, then you can have a good market. You can have a good business. So, really excited and bullish about that to go further into that. The second one, geographically, Southeast Asia, is one we're really excited about. And yeah, there's a lot of talk of it's not a new thing, but just going to delve into the details of it. People said, okay, well, China's a huge market. There'll only be one more, and that's India. And actually, we think Southeast Asia, it's not just a growth market, but it belongs in the same bucket. So we put that as a kind of a second step, even perhaps before India, because it's investable now. And the reason we believe that is, if you look at, again, kind of the fundamentals from the bottom up, 800 million people, but there's very little, very little poverty there. So most of your customers, most of the people living in Southeast Asia are what you would call, quote unquote, liquid customers. And so therefore the addressable market is pretty much the same size as China and India. And that's something that's not really all told. And again, there's about more than 10 countries, but China and India as well, very, very disparate, even though it's normally in one nation state, disparate regions. So very bullish about Southeast Asia for that reason. And the third one is Web3. I'm just curious to see where that goes. Again, over time, we're bullish about that. I think it's very exciting. And just again, the reason is maybe it also links to sports, but people increasingly, they want to immerse themselves into the technology. And that, I think, is a kind of, that demand will be there, so that will come next.
Great. Those are three very different areas, too. That's great. You've got some great diversification in your next strategies. Let's pause. We have a couple more minutes. I'd like to see if anyone has any questions of our, okay.
Hello.
Yep.
I'm from US, Indian born, educated, brand new venture capital from Carolina, not like you, New York, San Francisco. That's my biggest problem. I cannot meet you because of North Carolina, Charlotte. So
Mark telling you what?
Carolinas, Charlotte, North Carolina.
Carolina.
So from there, I know James, Bruce. I'm here. This is my first time. So anyone, we are a global fund manager working with US, India, Saudi Arab, Europe, and UAE. So we are helping investor as well as clients who are looking for money. Most of the people are India. So I'm from India. We are working with Modi as well as all his team. So without India, you cannot survive.
All right. But is there a question there?
This is my question. Definite, India is the top chart right now, the fastest growing economy.
All right, I got it. So the question is India.
Yes.
Any opportunities? Where do you see opportunity potentially in that country?
And
Let's
last 9 years, that country becoming a change because before that it was different because of Modi. I think
we got it.
already told how they change.
Go ahead.
Yeah, hugely bullish about India. It's just going there. I mean, we invest directly, so we will probably start with a fund, just because it's not the easiest place to go in direct. But for all the different sectors I've already said, they all apply to India.
Me too. Yeah, agreed.
Mark, what do you think about India?
Yeah, and basically, if the demographic winners don't grow, India, Philippines, Indonesia, and we're seeing some really constructive things there. I met the Sovereign Wealth Fund at Indonesia the other day. They're doing great work partnering with other large funds to try and get credible investment avenues into places like Indonesia. This is the place to be. Getting value in India is tough, but getting access has got to be a long-term play for sure.
Yeah, and I'm very impressed. I've been actually investing in India for 20 years. The Indian entrepreneur I would not bet against.
All right, I think we've hit our time now. Thank you all so much. Thank you, committee. Well, a wonderful group here, and we'll take other questions afterward if we have them. Thanks so much.